And welcome to the Trading Zone. I'm Joe Teague, and what a start to the week, Brian.
Yeah, I'm Brian Stutland here, portfolio manager at Equity Armor Investments here on the Trading Zone. We do have quite a bit of a show here. We'll probably be kind of quick and dirty on what we're going to get after. Obviously, we want to update you guys on what's been going on with the markets today. Tons of volatility, Joe, and we've seen this before, but this is what happens when people get too complacent.
Yeah, I mean, we were talking about this last week. We are talking about the key places to watch. Just a couple weeks ago, we are talking about the VIX like 14, and what a big increase the VIX at 14 was. And maybe everyone thought, oh, now people think that volatility has come here now that the VIX was 14. Nuh-uh. We hadn't seen nothing yet. We saw 2 really rough weeks. We told you last week the jobs data is going to be critical, and we told you all year long when the Fed starts to raise rates, if the economy is getting softer, this market is not going to do well. And that's exactly what we saw at the end of last week.
Yeah, I mean, we've talked about this too, the yield curve when it's been inverted for so long and then the Fed decides to cut rates, or at least the market is anticipating now that this is going to happen. We're seeing even potentially 50 basis points cuts come September. Sometimes that's actually the Fed is a little bit too late to the party to do that, and the markets don't like that, and so you get a raise in volatility, and this is a circle of life of volatility, and we're seeing that live today, and the explosion that we saw off the open.
So Brian, this morning, pre-open, the VIX touched 64, spike index open at 54. We had the front month future way down at 32. Did that make you just want to jump out, get your trading jacket, and jump out on the floor and start trading up some more?
Oh yeah, definitely. I love these kind of days. Although obviously very nervous if you had the wrong position on, but if you could kind of keep yourself well balanced as a market maker, it was days like this where you kind of just raked it in really with all the level of volatility back and forth that occurs. And the VIX at 60 something was enormous this morning off the open. It'll be interesting if we can get back up to there again at that level. I'm not sure. It felt like a little panicky. It felt like people were blowing out of positions right off the open into overnight. Lots of stories out about Japan and their markets and how treacherous that was. It seems like since Europe is kind of closed here, that things have kind of simmered down a little bit in terms of the VIX, interestingly enough, but we'll see where it goes from here.
It just felt like there was no offers on any of these options. Volatility just kept rising and rising. I don't know if there was some sort of a liquidation event happening overnight. Maybe we'll read about that in the next couple weeks, but it just felt like the liquidity was gone. Everyone, sometimes that happens in the summer months. That might be like one of the risks that you have to trading, especially in super large positions. But it just felt like there was no bid in the market, no offer in any option.
Yeah. And then, I mean, you couple that, I kind of remember, and Joe, we've talked about this internally, amongst ourselves as portfolio managers, that this kind of felt like August 2007-ish, where the markets were experiencing a nice run. They kind of topped out a little bit in July, and then all of a sudden it just was a quiet period, and you got this explosion of the VIX.
Oh, wait, save that thought for a second, bro. We actually got a question here.
Okay.
Let me pull that in here. Maybe we can answer this. We can dovetail here. So, by the way, feel free to shoot in your questions as they come in. What are you keeping an eye out now that volatility had a spike like we saw this morning? Any historical events that you can allude to, like 2020, 2018, 2008? We were in the trading pit and the VIX pit back then. So, so what do you remember from 2007?
Yeah, well, okay. So it's 2007, August 2007 was really the start of the beginning of the top. The market went on after that time period to go on and make new all-time highs, but the markets had enjoyed such a great run to the upside. The VIX was very low on a relative basis. In fact, I think it printed below 10 back in February 2007. And all of a sudden, this complacency hit. It shook the markets up. The Fed had been sort of in a rate hike cycle to sort of calm down the housing market. And all of a sudden you got this volatility explosion over a couple of days, and it took really a massive shakeout. I would want to see the stock market kind of close where we opened at this morning, or if not a little bit higher, as a way of just like, hey, now some, bulls and bears have come in and balanced the market temporarily. And now that we gotten such a big shakeout in the VIX, maybe that was an ultimate panic for a short-term bounce here back to the upside.
I got to say, like, it has been a tremendous bounce off the low where we're in the open, and it has been a tremendous sell-off in the VIX. That is what I want to see as a contrarian. I want to see the VIX spike and the market have a reversal. I want to see that for the market to turn around. I don't know that we're there just yet. Maybe, I mean, you can make the case looking at the chart right here. If you're looking at it at home, watching, if you guys, everyone watching along is looking at the same futures charts that I am. It looks like it could want to make a little head and shoulders daily chart here. We are pulling back a little bit off of the intraday high. If we can make that right shoulder and turn back higher and make a new high, if we reverse all the way and be up on the day with the VIX close to unch, that would be a tremendous move, and maybe whatever liquidation happened overnight is done with. Short of that, I mean, the other thing is possible too. Could drift back lower, trade closer toward the lows, then that'd be a real worrisome sign for me that there's just more volatility to come.
Yeah, and then I mean, going back to the question too, what happened in 2018, 2020, very kind of similar events where volatility was low. I'm going to kind of throw 2020 out because that was obviously very driven by a pandemic and just things basically shutting down. So, but 2018 Volmageddon, similar scenario where the markets had experienced nice runs up, volatility was low, the VIX was low. There was sort of this calm, and then boom, shakeout, because it had been such a long period of time before there was a volatility event. And again, that really felt, that too back then felt like almost a short volatility trade squeeze on people, similar to what maybe we're seeing today. And then, go back just to 2008. I talked about 2007. The markets re-ran up after August 2007 to the top in 2008. And then what really shook the market out was commodities and crude oil. So that was a little bit different as well. This kind of feels like a 2018, which in both scenarios, 2007 or 2018, both those, actually the back half 6 months later was not great for the stock market. So something to keep an eye on. We may get a short-term bottom, Joe, like you talked about, trying to get that head and shoulders bottoming process, put on that other right-hand shoulder here. If the market sort of hold 5,200, I would say, on the E-mini S&P futures, right around that area, and then can maybe re-rally back towards the intraday highs that we just saw, half an hour ago. Maybe that's a short-term bottom for the market to rally. But I would put my trader hat on for the next, call it 6 months, and look to trade the markets back and forth.
Yeah, so that should be an exciting time. I would just say, back to the Volmageddon point, that's something we've been talking about a lot on our show. If you're new today, if you're just joining in for the first time today, make sure to watch us every week. Make sure to like, follow, subscribe, all of those things. But we've been talking about the risks of Volmageddon 2.0 really for about a year now, Brian. I've been talking about how in 2018, it was people getting into short VIX futures. That was a very popular trade. People were just loving the fact that they thought they were printing free money, short VIX futures, until they didn't, and they lost all their money. A lot of people, a lot of really bad advice was given ahead of the Volmageddon. But ahead of this event, there's been record inflows into short volatility ETFs, something we've been talking about for a very long time. At some point, people who are in these short volatility ETFs, they think, I'm collecting cash. That's the new way to hedge. I'm not going to be exposed to any potential downside. At some point, they start to see some downside. They run for the exit at the same time. Everybody's trying to buy volatility at the same time. That's when you might see the VIX up at 64 for a heartbeat. So that was what we've been warning about for some time.
Well, it's not just the short VIX ETFs too, Joe, though, but I've seen a lot on the stats on Bloomberg indicating that there was been massive inflows into some of these leveraged ETF types, like a semiconductor, 2x, 3x leverage that they have out there, and other ETFs that are double or triple levered to the market, to the upside. And then, so what happens? People have those positions on, they're double or triple leverage, they get a margin call, and then all of a sudden they have to sell, and they sell at any price. And then you're talking about 2 or 3x times the market that needs to, then market makers need to retrade out of that. And that really drives, pricing on the stock market lower. So that's maybe something that we saw today, this morning.
100% risk off. 100%. You got the Bitcoin in a lot of people's faces down 20% off the open. There was some major de-risking happening, just complete liquidation going on. So that was fascinating. But hey, you know what? We've been talking for a while. Again, thanks everybody for tuning in. Let's start the actual show of the show.
Yeah.
Kind of an abbreviated show for us. We've just been talking markets for some time, but we're happy you're all here. This is what we do every week. And we got this big uptick in the volatility, but as I mentioned, volatility has plummeted all the way back down to the mid 30s in the VIX. But Brian, one thing that's interesting is we're not seeing the typical panic, the typical volatility in the credit spreads. There's been no really crazed exit out of some of these risky assets, these risky bonds. Nobody's really saying, hey, there's a huge liquidity crunch there. So that's one feather in the cap, maybe, of bulls here. People are thinking that the rally can continue.
Yeah, I mean, when you look at the credit spreads, the CDS market, obviously that's probably pretty good news for the banks that they're not going to have some major systemic risk here. But I mean, I would still turn to the fact that when you look at what the Fed might need to do in terms of stamping out probably what seems to be like a recession now, because you look at the ISM numbers that came out last week, you look at the unemployment report ticking up more than people expected in terms of the rate going to 4.3%. All these are sort of indicative of a pending recession. And what happens during recessions, you get sell-offs in the market, you get lack of liquidity. And until the Fed can lower rates far enough to sort of inject that liquidity back into the system, you have some shakeouts here. And so, yes, the CDS market is looking stronger, and that probably means there is sort of a put in the market, so to speak, a stop out point, where if we did get further selling, that liquidity that is occurring in the bank side will allow some institutions probably to step in and start to take positions and look for bottoms in the market. Just as Joe, you and I would, when we see VIX spikes in the 30s, that's some opportunity to sort of dip back into the market. We even sold some in the money puts, or synthetically did that ourselves for clients today when the market was lower.
Yeah, had to trade it up for us and for the clients especially. Do you think Warren Buffett, who sold a ton of Apple last month, do you think he's selling puts on the market right now, just gladly collecting these premiums, gladly looking to buy some stock back cheaper?
Yeah, and he wasn't only selling Apple, he was selling Bank of America too, a big chunk of that. So he obviously has had some inclination, or at least Berkshire as a whole has had that, where maybe the market was looking a little toppy. They're good. They are good at picking stocks and when to get out.
Yeah, well, they love selling puts too. Love collecting those premiums and love buying stocks cheaper. So they're very happy with this increase in volatility. Very happy that these stock prices are lower because they like buying stocks lower.
Yeah. So what do we got? We got Trading Zone. Oh, before this, we just want to mention that when you look at the week ahead, it's not a big, huge week. Jobless claims, obviously, people will look at.
I wrote buckets. Last week was a major week.
Yeah.
This week compared to last week.
Yeah, I know. It feels like this is really nothing. So not a whole lot to react on, other than maybe some Federal Reserve banker speaks out about interest rates now that we're seeing the market price in potentially a 50 basis point cut in September. But other than that, really nothing on tap this week.
Yeah, the 50 basis points is like 100% priced in, which is shocking to me. I think it would just take one chairman or one Federal Reserve governor to say, hey, 25 is still what we're going to do, and the market would snap back. I think the market would actually like that. They'd like to see the economy. Yeah, there was one bad jobs number. It doesn't mean everything's falling apart all at once. We'll see. I mean, I think actually does tend to happen when you start to see this economy slow down. Usually you get like a weak number and then like maybe a couple weak numbers and then like a really disastrous one. Maybe the stock market is just anticipating that's going to happen. But to go from, where we were, just in April where we said, oh, there's no cuts needed, the economy's too hot, inflation's too high, to now we need 4 or 5 cuts by the end of the year, is just really shocking to me to see how drastic this is shifting. I don't know the economy is moving as fast as the bond traders are saying, but Yeah, I'll just trade it as it is, and be thankful that we got the volatility spike.
Yeah, really. So, I mean, we'll see. I think this is going to be a lot of technicals over the next few weeks. And just getting into the volatility zone here on where things are, you can see the massive amount of put buying that occurred in the skew index. Obviously, this is a measure. Again, we talk about this every week. The measure of the value of an out of the money put, which is insurance on a portfolio, so to speak, versus an out of the money call, which is a leverage play to owning stocks to the upside. You can see puts were very much in play over the last couple of trading days, and especially today relative to calls. So people really wanting and clamoring to sort of protect something on the downside, and major put buyers.
Yeah, no, if you're new watching us about volatility, this is something to look at every week. This is going to be really critical for the path forward here, Brian, because we love to look at the skew as a leading indicator for the volatility. We want to see the skew coming down, and it usually will before the VIX actually does. It usually will start to come down. The VIX might even make a new high, but this thing won't. The skew index won't. That'll be a big index, big clue for us that maybe the volatility spike is done. Now, that said, it's very hard for volatility to maintain at these levels. It's very hard to volatility to maintain at these 50 levels. It very often reverts to the mean. That's what we expect. That's also what we expect on the skew. So we'll just see how it's trading. But it's very tricky if trying to trade volatility with these futures, because the futures traders anticipated that there was a massive discount on the cash on the front month future, the August future, to where the cash was. So it's very tricky to trade these futures.
Yeah, and like Joe mentioned too, is we want to see this skew index come down, and that be an indicative value that people are actually buying calls and trying to make a play to the upside. But yeah, Joe, you turn to
this. If you are familiar with the VIX, this does look a lot like the VIX of the past couple of years. We've seen this like declining, chart here. We've had lower highs here in the VIX, lower highs here in the skew. So this does look very familiar, and we absolutely smashed through that today in both the VIX and in the skew.
Yeah. Then, turning and looking at the VIX futures curve, obviously it's higher. The VIX is higher. VIX futures are higher. It is interesting how steep a premium the VIX itself is to the front month VIX futures contract, which actually makes owning some of these VIX futures somewhat attractive. Now, I mean, look, we've had a spike, so it's difficult to say, oh, I'm going to buy VIX futures and then hope they generate positive returns, because the mean reversion is for VIX to be lower. But the discount to the cash itself right now to me seems very attractive, and this is a trade that we look to kind of put on earlier this morning, right, Joe?
Yeah, I mean, you can't not just look at that discount and just think about the potential arbitrage there. Really, I think that's absolutely a seasoned way to trade it. Just taking the opportunities when it comes. The other thing I want to point out, Brian, is that we've been talking about, before we had this bout of volatility 2 weeks ago, basically October is when the volatility is being priced into these futures. Just look at where we were a week ago. We were like, oh, wow, look at how high this October future is at like 18, and now it's completely inverted. It looks more like, like a stock skew rather than a VIX skew. Like, you get the downside bid up and the upside is cheaper, of course, but is really, really inverted. We're on our heads here in the VIX, super steep between where the cash is, where the front is. But it's also just interesting, remember just thinking where we were a week ago or 2 weeks ago, that October future is now lower than September and August.
Yeah, that finally went back to the other way around on that. And so, I think temporarily, to me, this is one trade that obviously we have positions in the VIX for clients. Maybe if the VIX comes off more and I want to add volatility positions, I would probably go further out on the curve now that stuff is lower than the front end of the curve. Even if it kind of comes back in line, I think the back end stays somewhat firm now all the way through the election, maybe for the next 6 months, like I talked about, because I still think there's going to be a lot of back and forth volatility action over the next few months.
Yeah, that should be fun to watch. This is something we bring up every week. Make sure to check us out every week. Feel free to ask any questions about volatility. That's what we're here for. That October VIX has been the one to own for some time. Yeah. Let's take a look at the trends, which we've been following all year long, Brian, and we were riding this higher. Now, it remains to be said, like, we're still actually in an uptrend here. We're still above this longer term trend channel. So that's, I guess, a positive, but we had this accelerated trend channel we've been in, since November of last year, which we completely crashed through last week and is just diving on a nosedive lower since.
Yeah. So, I mean, the concern here now is we go back into that lower upward sloping trend channel as a real risk to where the market is at. But given the amount of flush out that we just saw, I'm not certain that gets down into that lower channel so quickly. There's obviously some downside risk now in the market. We know that recessions have very steep corrections from highs to the trough bottom if a recession is coming. And so, unless the Fed can kind of stop that out fairly quickly. But right now we're kind of in no man's land. We're in a spot where, like I said, this, not only have we talked about the level of fear and panic shaking things out and creating some volatility back and forth in the market, but I think the technicals line up where now we're in an area where there's no support, there's no resistance for, a couple 100 points up and down in the S&P, and I wouldn't be surprised to see it swing around there.
Yeah, there's some interesting, Fibonacci levels are interesting, moving average levels. But this point in here is going to be really critical. If the sell-off is not over, if we do trade down here, it's going to be a really important spot. We'll see if we can hold that. I mean, my gut says it'd be really hard to break through there. But if we test it a few times, we will break through. And then possibly just see something like this. Just get this head and shoulder bit longer term. It's more than likely, if we are going to be into a recession, it's probably what we're going to see. And this will take, a whole quarter probably to play out.
Yeah. And actually, we picked up this chart kind of a little bit more when the market kind of rallied from the bottom. So I do think we were actually very much closer to that, support area that Joe was talking about here earlier this morning. So we'll see if it can really bounce and hold off of that. And yeah, Joe, I would agree with you that likely you get that bounce off that support line, and then the market tries to see where it can go from there. And the next round will be, quite critical and dangerous, whether somebody who is a bull wants to, finally step back and put cash aside.
Yeah, I don't know. Let me know what you see. If anyone else sees any patterns there, let me know. Certainly looks a lot worse in a lot of the tech heavy indexes, semiconductors. I'm sorry. That chart does not make me feel good. I'm already feeling a little under the weather, and that one might send me to the toilet. The NASDAQ is not looking good either. There is some hope. There's some hope here in the S&P 500. The data needs to be better. The economic data needs to right itself. It needs to be just a one-off. That was a little bit of a weak jobs number, and we can move on from there. That, for me, is the best case scenario. The best case scenario is the economy does a soft landing, a very slight recession. The Fed can lower rates, and we can rebound. Worst case scenario is the economy, of course, does not do as well, and the Fed has to be a lot more aggressive.
Right. And, normally on the show, we give a stock trade or whatever. We didn't put anything together this week. There's so much action just in the general indices. We felt like we kind of talked about it. Our stock trade was just really trading, talking about the S&P and where that could go and head and how you want to hedge. So that's where I will stand on that. This has been a pretty good show here, Joe, for just kind of wrapping together. I didn't even have time to shave today. I woke up at 3 a.m. to recheck the markets, woke up again at 6 a.m. and I'm like, let's prepare for the day. So, I am glad we took a few minutes here. What's that?
You're absolutely trading them up.
Yeah. And so, we'll bring more to you next week. Make sure you tune in every Monday.
We were a lot closer here off the open. We're actually 52.50, right? Basically 52.45 right now.
Yeah.
we might be making that intraday head and shoulders bottoming formation right now. It's playing out before my eyes.
Yeah, it is hanging in there. You are right, Joe. We'll have to watch that. I may not have to sit still on this camera for too much longer and take some action here for our clients and see what we need to do. A lot of our strategies actually have had about a 40 or 50 beta to the market that we put on for people. Obviously, all this involving, we talked a lot about the S&P. We do own put options. We've made trades against those. We added some VIX futures positions. So we'll probably have a little bit more action to do as the market sits about S&P down about 230 basis points right now. And Joe, what kind of level, before we go and jump out, what kind of level are you looking for to say, yeah, head and shoulders bottom here on the daily chart where it's like, oh, okay, maybe we did kind of puke it out?
We're looking about 52.80.
Okay.
52.79 would be relative high, making that last shoulder, and decisively trading above there. That would almost bring us back to close to unch on the day. So if that happens, it would feel like a reversal. Doesn't mean that everything is done, but maybe a lot of the short-term pain is out of our system.
Okay, so there we go. We even talked ourselves into the stock pick of the week. It was the S&P trade.
I think the other thing we'll be watching, of course, is rebalancing. We got some major pain in some of the biggest growth names of the year. NVIDIA just way down. Something that we lightened up a few weeks ago. Is that a time to change that weighting again? Some to relook at.
Yeah, I mean, I would consider, like, if you've had a portfolio, it's probably gotten, kind of out of whack. I would try to rebalance and get back to the weightings that I had a thesis on things. I mean, I did that as well. So I think this might be a good, rebalance, or if I've had cash set aside, I'd be looking to put that to work as well.
All right. I think that's a good one.
Wait for that level. Wait for that level that Joe just talked about on the S&P. That's what I'll be watching here this afternoon.
That'll work.
All right. This is Brian Stutland of Equity Armor Investments with my colleague Joe Teague. Joe's feeling under the weather. He still came here to talk with you. I haven't shaved yet. I got to go back and trade right now. Please tune in every Monday, 1 p.m. Eastern. Join us here on the Trading Zone, sponsored by the MIAX. Love having you here, and we'll catch you next week.
Thank you.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.